Welcome to My Steel Commodity Flux, the podcast where we track the trends, turns, and turbulence shaping global commodity markets. This is Nikki Fu, Commercial Director at My Steel Global, in charge of new business sectors growth strategy. In our June 2nd episode today, we're going to have a quick glimpse of the latest Chinese LPG market update. China's LPG market saw one of its sharpest corrections in recent weeks. Brent crude fell nearly 9% week on week. China's domestic LPG prices dropped more than 5%, and futures slipped below 5,700 yuan per ton as traders aggressively priced out Middle East geopolitical risk premiums. Despite the sell-off, physical market conditions haven't pointed to a clear supply surplus yet. Middle East LPG exports remain constrained, freight costs are elevated, port logistics are still under pressure, and China's PDH demand is gradually recovering. So why is the market suddenly trading like oversupply concerns are returning? To break it down, we're joined by Aibo, lead LPG analyst at My Steel Oil Chem. Aibo, great to have you back.
Glad to be here.
Aibo, last week really felt like the market started pricing in future supply recovery before actual supply recovery happened.
That's exactly what happened. Once the market became more optimistic about U.S. Iran negotiations and the Strait of Hormuz situation, traders immediately started removing geopolitical risk premiums. Crude sold off first, and LPG followed very quickly.
But the physical market isn't really recovering, right?
Not yet. Middle East supply is still relatively constrained, and shipping logistics remain tight as well. So supply and demand balances didn't collapse last week. Prices simply corrected much faster than fundamentals weakened.
And that's creating a pretty unusual structure right now, because import costs remain relatively high, while China's domestic prices are falling aggressively.
Exactly. June Saudi CP saw an increase from last month. Freight costs remain elevated, and import costs are still under pressure. On the other side, China's domestic demand remains soft, especially on the residential side, so local prices kept moving lower. That pushed import margins even deeper into negative territory last week.
And downstream buyers also seemed extremely cautious last week.
Yes, most buyers stayed on the sidelines, waiting for prices to stabilize. But toward the end of the week, once prices dropped to lower levels, we did start seeing some replenishment demand gradually return to the market,
which suggests demand itself may not be collapsing as aggressively as prices are implying.
Exactly. The market was bearish in the futures market, but physical demand has some solid support. In fact, some parts of the chemical sector are actually improving.
Especially PDH. I can tell from our database, operating rates moved back above 60% last week, and more resumption from maintenance is expected this week.
Yes, and honestly, PDH is probably the biggest reason the market doesn't look significantly weaker right now. Propane's chemical demand is recovering gradually, and that's helping ease supply surplus pressure.
But other chemical sectors still look weaker.
Yes, alkylation and MTBE operating rates both declined last week, so chemical demand itself is somewhat fragmented. That's another reason why the market feels so volatile right now. Some downstream sectors are recovering, while others remain sluggish.
And inventories data also tell a pretty interesting story last week. Port inventories declined slightly, nevertheless producers' inventories continued rising.
Port inventories fell because chemical demand and downstream trading activities improved somewhat, while producer inventories kept rising because China's domestic spot trading remained relatively weak. So again, different sectors of the value chain were moving in different directions.
Understood. Aibo, I think last week's volatility also reflects something much bigger happening structurally across the global LPG market. It no longer feels like a market driven mainly by traditional supply and demand fundamentals.
I agree. The global LPG market structure is changing quite significantly. Historically, The Middle East was viewed as the market's most reliable supply anchor, but repeated geopolitical disruptions have forced the market to think more on the risk management.
At the same time, U.S. supply is taking up a larger supply share globally.
Exactly. The US now accounts for roughly 46% of global seaborne LPG exports, and April loadings reached a 5-year high. So structurally, the global LPG market is becoming increasingly dependent on US supply flows.
How about Asia? Does it move in one direction?
Not at all. India's LPG imports continue growing rapidly, especially for US cargoes. Meanwhile, demand growth in Japan and South Korea is slowing structurally. And, China is becoming increasingly important in determining regional balances.
Especially when China's domestic LPG demand structure has changed dramatically over the last few years.
Correct. China's chemical demand for LPG has already surpassed residential demand, and more than 40% of total LPG consumption now depends on imports. That means China is now much more exposed to global supply disruptions than it was previously.
And that's why geopolitical events now move the LPG market much more aggressively than before.
Absolutely. A few years ago, China's LPG pricing was mainly driven by traditional supply and demand fundamentals. But today, geopolitics has become one of the market's dominant pricing drivers, and last week was another clear example of that.
True, even after last week's sharp correction, prices are still sitting well above historical norms.
Yes, propane and butane CFR Far East prices remain significantly above pre-February levels this year, despite the recent pullback. That tells you the market still believes supply risks haven't fully disappeared.
So, in many ways, the market isn't just reacting to weekly headlines anymore, it's trying to adapt to a completely different global LPG environment.
That's right. The market may be pricing out some geopolitical risk right now, but structurally, LPG is becoming far more geopolitically sensitive than it used to be.
In summary, while prices may continue reacting to short-term geopolitical headlines, the bigger shift may already be underway, a global LPG market that is becoming structurally more dependent on geopolitics, trade flows, and supply security than ever before. Ibo, thanks again for joining us today, and thanks to everyone for listening. If you'd like to follow these developments in more details, the full analysis and data behind today's discussion are available through MySteel Oil Chem's latest China LPG Market Weekly Report. For more comprehensive midterm insights into China and Asia, LPG markets, including supply flows, demand recovery, and geopolitical pricing risks, contact us at inquiries@mysteel.com or search for the keywords China and Asia LPG Market Analysis and Outlook, May 2026 on mysteel.net for the full episode and explore how shifting trade flows and geopolitical developments are reshaping the regional LPG market. And for those who would like to follow these developments in a more structured and forward-looking way, China Policy Perspective helps decode China's policy direction, energy security priorities, and the broader market implications of geopolitical disruption. Reach out to us for a sample issue. For more information, please visit mysteel.net or contact us at inquiries@mysteel.com. Thanks for tuning in to MySteel Commodity Flux. If you found today's episode useful, be sure to subscribe for more insights into global commodity markets. Until next time, keep tracking the flows.